He has a master's degree framed on his wall. He reads 3 books a month: history, economics, psychology, things that make him interesting at dinner parties. He earns $88,000 a year, which isn't life-changing money, but it's real money, more than both his parents ever made. He can explain inflation, talk about interest rates, hold his own in any conversation about markets or policy or the economy. And he has $4,200 in savings. At 34 years old. After 11 years of working. That number sits in his stomach like something he swallowed wrong. How does that happen? How does someone smart enough to understand the system end up losing to it anyway? This is the question almost nobody asks out loud. Because the assumption is that smart people figure money out. That intelligence is a kind of protection. That somewhere between the degree and the vocabulary and the bookshelf, the financial stuff just takes care of itself. It doesn't. And the reason it doesn't is stranger and more specific than you'd think. Let's follow him back. Not to judge him. To understand him. Because there's a very good chance you recognize him. He's 23 when he gets his first real paycheck. $3,400 a month after taxes. He's heard about investing. He's read some articles. He knows the basics. Compound growth, index funds start early. He sits down one evening with every intention of setting something up. And then he starts researching. Which broker is best? Which index fund has the lowest expense ratio? Should he prioritize a Roth IRA or a regular brokerage account? What about tax implications? What about the current market conditions? Is right now even a good time to start? 3 hours later, he has 17 browser tabs open and has made exactly 0 decisions. He closes the laptop. He tells himself he'll come back when he understands it better. He's a smart guy. He'll figure it out properly when he has time to do it right. That night costs him more than he will ever fully calculate. Not because of what he decided. Because of what he didn't. Here's the thing about intelligent people and money. Intelligence is a tool that was built for solving problems with clear answers. You analyze, you research, you find the best solution, you act. That process works brilliantly in almost every professional context. In finance, it creates a trap. Because with money, the best answer almost never reveals itself through more research. The market doesn't reward the person who understood it most thoroughly. It rewards the person who acted earliest and stayed consistent the longest. And smart people, people trained to find the optimal answer before moving, spend years researching an optimal answer that was never coming, while the person who just put $200 a month into a basic fund at 22 and forgot about it is now sitting on $140,000. He's 27 now. He finally starts investing. But he doesn't do the boring thing. He's too smart for the boring thing. He picks individual stocks, companies he's read about, businesses he understands, sectors he follows. He builds a portfolio with real thought behind it. And for a while, it works. His picks do well. He feels something that feels like confirmation. Of course he could do this. He understood what he was looking at. Then the market shifts. 2 of his top holdings drop 40% in 6 months. Not because the companies failed. Because the sector rotated. Because institutional money moved. Because things happened that had nothing to do with how well he understood the product. He sells at the bottom. Because the logic that told him to buy those stocks in the first place can't find a reason to hold them at a loss. He gets out. He loses $11,000. He spends the next year not investing at all, which costs him more than the $11,000 ever did. What happened there is something behavioral economists call overconfidence bias. And it hits intelligent people hardest, not least. Because knowing a lot about something real, a company, a product, an industry, quietly convinces the brain that it knows more than it does about the adjacent thing. The engineer who deeply understands the engineering assumes he understands the stock. The doctor who knows the drug's mechanism assumes she understands the pharmaceutical company's financials. The knowledge is real. The confidence it generates extends far beyond where it's actually valid. And the market charges a very specific price for that extension. By 29, he's earning more. A promotion. $104,000 a year. And here's where the story takes its most expensive turn. Because what does a smart, ambitious person do when they earn more? They upgrade. Not recklessly, thoughtfully. A better apartment, because he's working long hours and his living space matters to his productivity. A newer car, because his old one was unreliable and reliability is a legitimate concern. Nicer restaurants, because he works hard and he deserves to enjoy some of it. Every single decision has a rational justification. That's the terrifying part. He's not being impulsive. He's being reasonable. And his net worth stays almost completely flat for 3 years, because every raise gets absorbed before it can become anything. This is what income without assets looks like. And it is shockingly common among educated, high-earning people. There are doctors pulling $280,000 a year with $30,000 in savings and $180,000 in lifestyle debt. There are lawyers who have billed millions of dollars over their career and have a net worth that a 28-year-old teacher who maxed her Roth IRA every year would beat without blinking. The income number and the wealth number are completely different things. Everyone knows this intellectually. Almost nobody lives like they actually believe it. Because the income feels like wealth. It feels like security. It feels like proof that everything is fine, until something goes wrong and the income stops, and you discover that the lifestyle you built requires exactly the income you were making, down to the dollar, with no room to breathe. He's 31 when he has the conversation that changes something. Not with a financial advisor. With a colleague who makes $12,000 less than him and has $90,000 invested. He asks the colleague how. The answer is almost insultingly simple. A low-cost index fund. Automated contributions every month. Never touched it. Never tried to beat anything. Never researched the optimal moment to start. Just started. He sits with that for days. And the feeling that comes up isn't inspiration. It's something harder. The slow, uncomfortable realization that the intelligence he'd been so proud of had spent a decade building elaborate reasons not to do the simple thing. The research spirals. The stock picks. The justified upgrades. The plans to start properly. Every single one of them was his own mind, dressed in logic, talking him out of acting. This is the part smart people rarely admit. The same brain that can analyze a complex problem, construct a 12-step argument, and win any debate, that exact same brain, when it's anxious about money or protecting its own ego, becomes the most sophisticated procrastination machine on earth. And the sophistication makes it invisible. It doesn't feel like avoidance. It feels like due diligence. At 32 he starts. Not perfectly. Not with a brilliant strategy. With a $400 automated monthly contribution into a total market index fund, the exact thing he could have done at 23. He doesn't research the optimal entry point. He doesn't wait for a dip. He sets it up on a Thursday afternoon and closes the laptop before he can open more tabs. The decision takes 11 minutes. The delay cost him 9 years. But here's what shifts in him after that Thursday. It isn't the $400. It's the identity adjustment underneath it. For the first time, he stops using his intelligence to build the case for waiting and starts using it to build the case for staying. He reads about why people sell during downturns and decides in advance that he won't. He understands compound growth well enough to make it feel real, not theoretical. He knows enough about behavioral bias now to recognize when his own brain is constructing a reason to stop. The intelligence doesn't disappear. It just changes sides. 2 years later, his portfolio is at $14,000. Not a transformation. Not a miracle. But real, and growing, and entirely his. He earns $110,000 now. His lifestyle hasn't changed much from when he earned $88,000. The gap between those two numbers goes into the account every month, quietly, automatically, without negotiation. Back to the bookshelf. The master's degree on the wall. The $4,200 that sat there for so long it felt like a verdict. The thing about that number is it was never a statement about his intelligence. It was a statement about what his intelligence had been pointed at. For a decade, it had been pointed at everything except the thing that needed it most. Not because he wasn't capable. Because capable people have the most convincing reasons to wait. The question isn't whether you're smart enough to figure out money. You are. The question is whether you're going to use that intelligence to act, or to explain, very articulately, very convincingly, why you're not ready yet. Because somewhere right now, a version of you is opening a browser tab. Maybe it stays open this time. Maybe 11 minutes is all it takes. The smartest thing you'll do today might not be the thing that requires the most research. It might be the thing you've already understood for years, and just haven't done yet. So close one tab. Open one account. Do the boring thing. The version of you 10 years from now isn't going to remember what you were waiting to understand. He's only going to remember whether you started.